Good morning, my name is Sarah Hare. I'm a Senior Marketing Manager here at BetaShares, and I am delighted to welcome you to the latest webinar in our series, BHYB, a new way to access the hybrids market. We launched our hybrid fund in April, so it's great to be able to bring some additional information, answer some questions, and share a little bit more about the fund and the strategy behind it. I will remind you that everything that we talk about today is general in nature. It is very important that you do your research, seek financial advice, and information can be found on our website. Past performance is not indicative of future performance. Throughout the session today, we would welcome your questions. You can ask a question on the right-hand side. There's a widget. Type your question and we'll try and get to as many as we can at the end. A recording of the session and a copy of the slides will be sent to all attendees after the session today. For those that may not be aware, but hopefully you are, BetaShares is an Australian fund ETF provider. We have over 63 funds on the ASX, the broadest range, and we've just reached 18 billion in funds under management. We pride ourselves on creating intelligent investment solutions for Australian investors with that Australian investor outcome in mind. I'm delighted today to introduce my colleague, Cameron Gleeson. He's a senior investment specialist here at BetaShares and is responsible for working with our portfolio managers and our distribution teams on portfolio construction and ETF implementation. It's great to have Cameron, and I'm looking forward to learning more about hybrids.
Thank you, Sarah. Thank you for having me. Welcome to all listeners, and particularly those in Melbourne still under lockdown, doing it tough. So today we're going to introduce hybrid securities and talk a little bit about the features of hybrid securities, which are really unique in a lot of ways in terms of investable assets. We're going to look at the outlook for the Australian banks, who are the major issuers of hybrids in this market. We're going to talk about BHYB, our exciting new hybrid ETF, which has been brought to market in April of this year. We'll also reintroduce HRBD, hybrid, our Australian Active Hybrid Fund. And we'll talk about how hybrids can fit within an investor's portfolio. So firstly, thinking a bit about hybrids from an investor's perspective. Look, before we do that, let's think about the issuers of hybrids. Why do banks and financial institutions issue hybrids in the first place? Well, the reason for that is they're actually incentivized by regulations on how banks and financial institutions are governed and how they must be run. And so because of these incentives, banks offer attractive level of income to hybrid investors. And in a low interest rate environment, the cash distributions along with attached franking credits stack up relatively well versus cash and other fixed income investments. Hybrid investments offer floating rate or variable distributions. So this means the distributions vary in line with changes in general interest rates. And due to this feature, the price or the value which you can sell your hybrids is relatively stable in a changing interest rate environment, unlike fixed rate bonds. So there are a couple of examples of advantages of hybrids, but of course hybrids come with a level of complexity, and it can be difficult for an investor to get their head around the risk-return trade-off for hybrid securities. Hence why a lot of investors seek an actively managed approach to accessing this asset class. To talk about the characteristics of hybrids, and these characteristics or features are really broken down into debt-like characteristics and equity-like or ordinary share-like characteristics. In terms of debt features, they rank ahead of ordinary shares in the capital structure. They pay regular quarterly distributions, which are defined in the prospectus for the hybrid securities. they offer issuers the ability to repay the face value of the hybrid at an optional repayment date. Then looking at some of the equity-like characteristics, they rank below senior fixed income within the capital structure. And under certain circumstances, they can in fact be perpetual, so with no set end date. The issuer may also suspend distributions, although that said, there are a range of incentives to encourage them not to do so. And in some cases, hybrids can be converted to equity, and actually in extreme circumstances, may be written off entirely in a period of extreme financial distress for the issuer. To illustrate how they work in a little more detail, we've provided this time frame for a typical hybrid security issued by an APRA-regulated entity, so a bank or an insurer. Typically, what you expect and what you hope for with a hybrid security is they're issued on issue date, maybe for $100 face value. You collect quarterly distributions, and then at either an optional call date or a mandatory exchange date, you receive back $100. That $100 may be in the form of cash, or it may be $100 equivalent value in the shares of the underlying issuer. And so these are the typical timeframes that we see for hybrids. There are obviously a range of features and risks associated with hybrids, and I don't have time to go through all of those features today, but I do want to call out one key risk, which is that hybrids have a risk of an extreme downside scenario. If we think about how Basel III hybrids, the current set of hybrids, were actually constructed and why they were constructed, regulators designed these hybrids after the GFC so that they could form an amount of loss absorbing capital in the event of another GFC style banking crisis. So the key risk to your hybrid investment is that extreme downside scenario, which obviously we hope is a very low probability. But in that case, there is a very large chance of loss of capital. And so that loss of capital may occur at any time if we saw that particular crisis. And it occurs due to two reasons. One is what's known as a capital trigger event. The amount of capital backing a bank falls below a set level. The other is when APRA, the bank regulator, declares that an issuer like a bank is non-viable. And under these circumstances or under other circumstances, the hybrids may be converted to ordinary shares in that bank. Now, typically, those shares you receive will be worth approximately the face value of the hybrid, but in these circumstances, and when the share price is now trading at less than 20%, or it's fallen by more than 80% since the issue date of the hybrid, you're very likely to see a capital loss in your hybrid. So, as I said, this is an extreme downside event, and that risk is real, and the risk is potentially quite large. But in the Australian hybrid market, we haven't experienced an event such as this to date. So pleasingly, the status quo is a very good outcome. For a full range of the risks, please seek and read the full prospectuses, which you can see on the ASX website for the underlying hybrids. So look, that's a bit about how hybrids work for an investor. To think about why a bank issues hybrids, it's important to sort of understand how a bank really works. Just wait for the coming slide to update. But a bank really, if you think about the way a bank works, a bank issues shares, it issues bonds, and it also offers deposits for customers. These are all ways for the bank to raise money or raise capital. What it does with that capital or that money is it will then offer loans to customers and make investments. And the objective of the bank is to make an interest margin on those loans or a return on those investments. So we're trying to obviously make a profit from borrowing and lending. So the loans and investments are seen as assets of the banks. What the key objective of the CEO and the board of a bank is to maximize the return for ordinary shareholders, or otherwise known as the return on common equity. So if we see the left-hand column, the bottom orange box, common equity. There are two key or easy ways, if you like, to increase your return on common equity. The first is to increase the risk of your assets. So for example, make more risky loans. And the second way is to reduce the amount of common equity you're using to fund your overall pool of assets. Both of those are things that banks, particularly a lot of overseas banks, engaged in doing in the lead up to the GFC. When those risky assets fail or experience credit defaults, then we can often see that the amount of those losses is enough to erode common equity. And we saw banks, particularly in Europe, get in trouble during the GFC. So this is obviously something which is against the best wishes of APRA, the bank regulator. So APRA likes hybrids because hybrids are able to be converted into shares and increase the amount of loss absorbing capital in the time of a crisis. Thinking about this from banks' perspectives, on the other hand, banks like this because it means that they don't have to raise additional capital, additional ordinary shares in order to meet APRA's requirements, but hybrids don't dilute the return on equity for common shareholders. So it's a good thing for ordinary shareholders and the regulators happy. Just to talk a little bit about the outlook for issuers. Look, the Australian banking sector is systemically important to the Australian economy. And we saw in the COVID crisis, again, the RBA, APRA and the government were prepared to act quickly to protect that banking system so that it was able to provide credit during COVID, during a time of crisis. The playbook that they used was very much built off the learnings from the GFC. So all the instruments and tools made available through that process. It's important to note that there's no explicit guarantee that in the next crisis, the government will again step in and provide support for the banking sector. But there are a lot of investors that believe that this historical pattern of behaviour is likely to be repeated in the next crisis. And for that reason, the risk-return trade-off for hybrids are favourable. If we look at the outcomes from COVID, one thing that's indisputable is that the fact that banks held back dividends or reduced their dividend payout ratios is definitely a positive for hybrid holders. It built up additional common equity buffers, so that those ordinary shareholder equity buffers that protect hybrid holders, and it also increased franking account balances, which we'll get to later. The outlook for our banking sector is very strong. S&P rates the sector as a 1 in 3 chance of an upgrade in the coming 2 years. That was updated in April. And we've also seen strong issuance in the hybrid market. CBA issued their Pearls 13 earlier this year. That's now trading at a premium. And ANZ just the other day announced their new ANZ Capital Note 5 offer, which will be offered with a margin above BBSW of between 3 and 3.2%, which Coolabah Capital, who manage HBRD, believe is a really attractive rate of return there. To look at the economy as a whole, and look, if you've tuned into any of Dave Bassanese, our chief economist updates, you'll know that the outlook for the Australian economy is strong. The sentiment has certainly rebounded. And unemployment leading indicators are very strong. Expectations for unemployment are only improving. If we think about fears of JobKeeper and what the end of that would mean, look, I mean, they've really been quite unfounded and similar to fears of the Y2K virus back in 2000, really. From the bank's perspective, another important thing to consider, as well as obviously unemployment, business conditions, is the housing sector, because banks obviously lend a lot of money to home lending. And so activity in that sector has been extremely strong. And we saw a rebound, particularly in owner-occupiers and first-home buyers. And now we're starting to see investors come into that market, and we just see all the data in terms of loan approvals ticking up, which is certainly a good outcome for our Australian banks. So this is one of the points I was talking about earlier, was the tier 1 or the common equity ratios of banks. So back in the depths of COVID, if you like, Q2 2020, APRA ran a number of scenarios on the banking system, and they included an extreme downside scenario, which included a 14% rate of unemployment, massive housing and commercial property crash and a multi-year recession due to repeat waves of COVID. Even in that scenario, they found that the level of capital, which would remain, the remaining level of capital after all these capital losses, was enough to sustain the banks and wouldn't result in an automatic conversion of hybrid securities. So pleasing to see that even in the depths of the crisis, our banks still looked pretty good. But obviously, even more pleasingly is how banks have rebounded, and holding back those dividends has really built up these strong capital buffers. We can just see how that Tier 1 capital has increased even further, and that's that protection that sits there to eat up any credit losses before hybrids are impacted. So that's very pleasing. If we look at capital on an international level, we also know that our banks compare extremely favourably. So the calculations for capital ratios in an international level are slightly different, slightly less strict than what APRA applies in Australia. But if we use internationally harmonised capital ratios, we can see how our banks, our big four banks, perform number 1, number 3, number 4, and number 6 in the world out of banks with over $1 trillion worth of assets. So clearly, there is if you like, a large margin for safety, and that's a credit to the banks and also obviously APRA, who's required that these banks are unquestionably strong. To look at some of the ways that you can access the hybrid market, we'll talk briefly about both of these funds, but really excited to have brought BHYB to market, our passive exposure. This is designed to be a low-cost passive exposure, but as mentioned before, HBRD is our Australian actively managed hybrid fund, been very well supported by the market. Both of these exposures offer low admin, low operational cost, exposure to a diversified pool of hybrids, and obviously that attractive franked income. And they both offer, if you like, a preference or a focus on the high quality hybrids in the market, which are those issued by Australian financial institutions. HBRD, or the Australian Active Hybrid Fund, is managed by Coolabah Capital and it was launched just about 4 years ago now with over $1 billion under management, very well supported by the market. It has a total management cost of 0.55 plus a performance fee. And essentially the advantages are plain to see in terms of investing in hybrids using an active manager, particularly given the strategy that Coolabah Capital, the manager, uses. With Coolabah Capital, you may have seen Chris Joy in the media, particularly the AFR, Livewire and alike. He is somewhat a larger than life character, but very insightful. Coolabah is a large team. There's a well-resourced team that sits behind Chris, and that they have excellent resources and very well regarded in the market. The strategy which Coolabah Capital use for an Australian Active Hybrid Fund targets a return well in excess of the cash rate. But one of the critical aspects of using an active manager and the strategy is that they don't have to remain invested in hybrid securities. They can move up the curve to those safer instruments. So for example, subordinated debt, senior bonds, or even cash, if they see that on a relative sense, hybrids are overvalued versus these other instruments. So there's a real advantage in using an active manager, particularly when we consider the investment universe in terms of hybrids, which the Coolabah Capital team can access. BHYB, our Australian Major Bank Hybrids Index ETF, was launched, as I mentioned, 2 months ago. This is an index tracking approach, 35 basis points. Received a lot of demand for this strategy. We're very excited to be able to bring this to market. Very simple in terms of the index construction. The focus here really is on providing exposure to the most liquid, highest quality names in the hybrid market, being the big four banks. And that is what really lends itself to a passive approach. So hybrids must already be listed and trading on the ASX. And we can see the issuer names shown there. There is a cap on any single issuer of 30%. and the index is rebalanced quarterly. So it's a relatively straightforward approach to building a hybrid portfolio, but obviously utilizing the ETF, we get all those advantages in terms of operational costs, scale, rebalancing, managing cash flows. It does, sort of bear the question, if I'm considering accessing hybrids through an ETF, well, which one should I choose? And I think we should sort of assess the relative value proposition of each. So HBRD is obviously leveraging that active management capability of Coolabah Capital. And because the range of securities that they can invest in is outside of just the big four banks, there is the potential to add more alpha. And we think about the ability to pick mispricing in securities. Hybrids are a somewhat complex instrument, and there are opportunities to pick mispricing. They can participate in attractively priced new hybrid issuance. And they've also got the ability to, if you like, pick up what's known as an illiquidity premium through investing in over-the-counter or unlisted hybrids. The risk, from a risk management perspective, HBRD can invest all the way through the capital structure, as I mentioned. So that's really providing you downside protection when there's a view that hybrids are, in fact, overvalued relative to other forms of fixed income. So when we think about this is really an instrument for investors that want exposure to hybrids, but really favor the use of that professional manager and potentially value that downside risk, particularly if they're not as comfortable with the overall risk return trade-off in the hybrid market. BHYB was brought out because there really was interest in a low-cost passive, if you like, beta exposure to the hybrids market. As I mentioned, the most liquid part of the hybrid market, only including ASX listed hybrids. And because we've identified or isolated the portfolio to that part of the market, there's less opportunity to generate alpha. And so it really does lend itself to a passive approach. So arguably, this is an approach which is most appropriate for an investor who has an appreciation for how hybrids work. They want that low cost, that low admin exposure, and they're happy to judge risk in the hybrid market themselves. So decide if they were to look to exit hybrids. We've seen interest from a wide range of investors, including model managers and institutional investors who are in fact running their own portfolio, direct portfolio of hybrids, in terms of the operational cost savings they can make by using BHYB, and also the price risk of investing in hybrids directly, as opposed to using the ETF to outsource that risk. To talk about how hybrids compare to other income securities, this chart here shows the running yield. So that's the current yield on these various securities divided by the underlying value or the market value in the case of hybrids. And we can see obviously they compare very favorably or provide a much higher level of running yield versus, for example, subordinated debt or senior bonds or obviously cash. One thing that's really interesting is a large portion of that yield, and the cash yield is higher than those other forms of instrument, but a large portion of that yield is the franking credits. And where this is interesting is that the banks, by reducing their payout ratios, have managed to build up excess franking credits, which, franking credits can only be used for attaching to ordinary dividends, for paying out share buybacks, and for hybrids. So in some senses, these franking credits are really, need to be used by the banks, but not useful for much else. So they've been able to supplement the cash distributions that they reward hybrid investors with those franking credits. So that's certainly a good thing for Australian investors who value franking credits. Another way to evaluate and compare hybrid securities is to look at credit spreads, which does take into account the current valuations of various securities. And again, on this metric, we see how favorably hybrids compare, albeit obviously that the fact that they are or should be considered a higher profile in terms of the risk, higher profile risk than traditional bonds, for example. So the next slide, which is just updated now, shows historical returns of HBRD since its inception in the middle column versus the Sole Active Australian Hybrids Securities Index, which is the broad hybrids index, if you like, for the broad market. And we also include Beehive's index for that period, given Beehive has only just launched. Now, what we have seen here is that if we look at the portfolio breakdown of the overall market, it consists of roughly 77% Big Four banks. So Big Four banks dominate the hybrid market, but there are also, if you like, lower quality or less well rated, financial institutions issuing hybrids, and they represent about 19% of the overall market. And then we've also got 4%, which are non-financial institutions. These are groups like Crown and Nufarm. And again, you would argue they're lower quality in terms of their makeup. In comparison, where HBRD sits at the moment, 85% in Big Four hybrids, 9% in non-financial institutions, and 6% in cash, which is obviously which is more secure. So hybrids portfolio tends, under the normal case, to be a higher quality exposure than the broad market. Hence, what you expect is you're probably going to see a slight lag in terms of performance. But that's important because we want to make sure that that portfolio is very liquid and we can trade all these names and we're not going to run into any crises. Beehive's portfolio, again, higher quality, being all Big Four banks. To talk through how hybrids perform in a crisis, we've included that sole active Australian Hybrid Securities Index in orange in this chart over a long period of time. And we've also included, just for a point of comparison, a number of other fixed income exposures and the ASX 200 Banks Index. What we see here is the broad hybrid market drew down in the COVID crisis, but the drawdown in banks was obviously far more, far greater in terms of the drawdown. It's worth noting that even gold sold off in this crisis. This was certainly a liquidity crisis. So gold, government bonds, everything sold off, but we can see the relative drawdown there. Importantly, what we saw in the COVID crisis was a very rapid recovery in hybrids. So that was certainly pleasing to see, was the drawdown was very rapid, but also very rapid recovery. To compare that broad market index, that sole active Australian Hybrid Index, we can see the performance of HBRD, so the actively managed strategy. Callback Capital was actually managed to protect us from some of that drawdown. So by using that active strategy, they were able to in effect protect the investors from roughly sort of reduction in the drawdown of roughly 2%, which is quite good given the broad nature of that drawdown. Beehive again being that high quality, just Big Four bank exposure versus the more risky broad exposure of the overall market, had a smaller drawdown during COVID. So just important to note how Beehive and HBRD have the potential to provide some level of protection in a drawdown versus hybrids as a whole. To look at the outlook for hybrids, and another way of looking at how hybrids perform is to look at their credit spread. So when credit spreads obviously blow out, then hybrids have sold off. We've seen the strong recovery, or if you like, the compression in credit spreads for hybrids. So this shows 5-year hybrids of the Big Four banks in orange, and we've seen that compress. What's interesting to note is the compression in spreads hasn't been as extreme as senior bonds. So relative to senior bonds, hybrids still look like they are relatively good value. The next question that we'd like to address, and it is a difficult one to look at, particularly given the nature of the audience on today's webinar, is where hybrids sit within a portfolio. And of course, we can look at this from a risk-return trade-off. We know that they are riskier in certain circumstances than some traditional fixed income, so senior bonds, for example, but less risky than shares, so less likely to draw down as shares might in an extreme crisis. So they sit somewhere there within a risk-return trade-off. But obviously, in terms of where you want to position this in your portfolio, whether you allocate this within growth or defensive, I'm not at liberty to comment on that. You've got to be talking to your financial advisor in terms of where that should sit, and that's going to be very unique to your particular portfolio. What you should be assessing is the level of yield that they can provide, which is superior than a lot of other fixed income, for example, the level of stability that they offer during periods of fluctuating interest rates, but also the potential for drawdown in that sort of extreme downside scenario. They're the sort of factors you need to be thinking about in terms of overall portfolio construction, very unique to each individual and the other assets they hold. So look, in summary, I'd suggest that hybrids really do offer a bit of a win-win scenario in terms of their benefit issuers, but they also, offer something really attractive to end investors. And the outlook for hybrid issuers has unquestionably improved, and the margin for safety has only strengthened through COVID and through the recovery. They offer, potentially an attractive alternative to fixed rate bonds in an environment where you think interest rates are going to rise. And now we're very proud to launch BHYBE, but we also have HBRD, which offers that actively managed approach for those that seek that type of exposure to this market. Everything I've said here today is general in nature. We haven't taken into account any personal circumstances. We've got a range of information on both of these funds on our website, including PDSs, investment cases and the like. I encourage you to go to the website to seek that out. But I'll now invite Sarah back on screen. I think we're going to answer some questions.
We are. Thank you, Cam. There's been quite a lot of questions coming through during the session, and I know that some have been answered during the course of the presentation, and we'll try and get to a few more. One common or recurring question was just asking about the inclusion of Macquarie hybrids. So you did talk about those other and non-financial issuers as being part of the index, and why isn't Macquarie included in that in BHYBE?
Yeah, so the BHYBE index is constrained to those big four bank hybrids. Those hybrids, they have an equivalent investment rating of investment grade, so they're BBB negative, and actually there's a 1 in 3 chance the next 2 years they'll be upgraded. In fact, the credit quality of those issuers is slightly higher than Macquarie, and so that's really important in providing a passive exposure. We want to make sure it's liquid, high quality, and trades well. Macquarie is rated 1 notch lower, so their hybrids are again a notch lower there.
And what are the factors influencing price volatility in the index? What economic drivers could lead to a capital loss over the coming 12 months?
Yeah, really good question. So if we think about hybrids, we mentioned how the distributions move in line with interest rates. So typically speaking, we don't expect to see a substantial amount of volatility due to changes in interest rates. The real factor that drives volatility or results in volatility in hybrids is the COVID style crisis. If there is a large question mark over the viability of our banks, and so it's that extreme downside to the overall economy impacting banks that we see as the risk. And if you look at periods where we've seen hybrid sell-off, it has been limited to those periods.
Mm-hmm. And a question: how does the floating yield work in relation to the RBA cash rate? Yields would expect to rise with higher rates. What and I know this is hard to answer, but what's the length that these should be held?
Yeah. Okay. So
a few questions.
Yeah. So I'll answer the first question. I mean, the way that the distributions on hybrids work is that they're defined within the prospectus as a margin above what's known as the bank bill swap rate. The bank bill swap rate is a rate that banks use to calculate a lot of their lending, and it's a 3-month rate which takes into account the market's expectations of changes in the cash rate. And so we'd generally view this as a relatively short-term rate, which will generally move in line with the cash rate. Now, where the cash rate changes, and that's been forecast by the market, we'll see that the overall rate will move in line with that. If there is a surprise, for example, the cash rate was to rise by 25 basis points when the market didn't expect, then the distribution in the following quarter will obviously have been adjusted by that. So there can be slight differences between how the cash rate changes and BBSW. Generally, they're very much in line, but the mechanism is a defined margin in the legal document over and above BBSW, which is BBSW, or the bank bill swap rate, is very much related to the cash rate. That was a long answer. I think the second part of the question was on investment time frames. Look, I just hesitant to ask to answer this question. Given the audience, I guess at a high level, I think you just want to be aware of the fact that there can be short-term drawdowns. So you wouldn't have wanted to be, requiring to exit your money in March last year, for example. But if you're able to hold hybrids for a more extended period of time, then provided we see a recovery, then we often have historically at least seen a recovery in the value of those hybrids. So without wanting to give any sort of personal advice on that or anything too specific, that's what you should be thinking about with regard to investment time horizon.
Mm-hmm. And just a few quick ones. The fee on this is 0.35%, right. And it is a monthly distribution. And just another question, a lot of differences and what hybrids actually are. So hopefully they have been answered during the session. But just people asking, aren't I better off holding the shares in the Big Four over this?
Yep. Yeah, no, good question. So I guess you would describe equity in the Big Four banks as a different risk profile to hybrids. I mean, we for example, we saw the drawdown in bank share prices, nearly 50% during COVID, and the time it took for those banks to recover was far greater. If we look at the 28-year run we had of economic growth with no recessions, clearly banks were a good investment. If we were to enter a different type of cycle where bank profitability was more questionable, then your chances of realizing a capital loss on bank shares is obviously going to be increased. Whereas hybrids, you should generally expect to receive your face value back, barring particular downside scenarios. So it is a different type of investment in that regard, and difficult to compare, but please seek financial advice in terms of the difference between the two. I hope that's given some color there at least.
Mm-hmm. And again, there is no minimum investment. There are minimums that can be imposed by brokers. So if you just have a look at which particular one you are using, but there is no minimum investment in the fund. Now, Cam, just one here. What could be expected to happen if the cash rate goes up?
Mm-hmm.
And then what happens if it goes minus? So just to...
Yeah, sure. So if we think about, I mentioned before how distributions are calculated, the bank bill swap rate, which is very closely tied to the cash rate, plus a margin. If the cash rate was to increase by 25 basis points, that will be incorporated into the bank bill swap rate, and the distribution on your hybrid will increase by that 25 basis point. There may be a bit of a lag because the distributions are set 3 months in advance of the distribution date or the start of the quarter. So if there was a surprise in the cash rate rise, then there may be a slight lag in that. But generally speaking, we say that they will increase as cash rate is increasing. And that's what really leads to that capital stability versus a fixed rate bond, because your income's increasing at a time when you can effectively earn more on other assets. So that's what leads to that capital stability in a rising interest rate environment.
And just a few references whether hybrid includes electric car exposure, lithium batteries, which is a lovely segue into our Earth ETF. Don't know if you want to say anything cheeky there, Cam, or if we stick on topic with bank hybrids.
Yeah, no, different topic entirely, I think.
Okay. So what, there's quite a few questions. We've probably got time for just a few more. What happens, franking credits? There's a couple of questions here about whether that flows through to hybrid holders.
Yeah, look, really good question. And I should say I showed some performance figures before, historical performance. They didn't include the franking credits. That was just the return excluding the franking credits. And the franking credits are a very important part of the overall return makeup, as we saw that they represent roughly 1% return. So the way that the franking credits work is that they're built in or baked into the legal document, the prospectus, under which hybrids are offered to the market. The franking credits themselves are not received in cash. As a hybrid investor, you would receive a tax statement at the end of the year, or as an investor in one of our funds, you'll receive a tax year, and that will state the amount of franking credits attached to each distribution. So you receive the benefit of the franking credits through completing a tax return and having those franking credits offset tax that you would otherwise have paid. So look, very much like an ordinary share that has franked dividends.
And just on HBRD, just in terms of dividend flow through to HBRD, and just fees on that as well.
Yeah, so look, if we think about the fund is holding a range of hybrids. It's holding cash and potentially sub-debt and senior bonds, depending on the positioning of the fund. And it's earning income on all those assets, and they may pay quarterly, monthly, regardless. That income is obviously, part of that income is being used to pay the management costs of the fund, and then the remainder is distributed monthly, because this is obviously an income style product and people like to see regular distributions. So that income is paid monthly, cash income, and then the franking credits associated with each distribution on the fund are attached to each distribution, but you only actually realize them through completing a tax return.
Okay. There are a couple of questions that we probably don't have time for, and we will be able to get back to you directly. I know some people have asked for us to contact them directly with some of their outstanding questions. Just a reminder that we will be sending a recording of the session and all of the slides. You can contact us if there is any further information. Thank you for joining us today. I do hope that has answered some of your questions and provided some information and insight onto our passive hybrid fund, and also giving you a nice update on our active hybrid fund. So thank you, Cam.
Thank you,
it's
Sarah.
been great, and we will see you next time. Thank you so much for joining us. Have a great day.
Thanks, everyone.